Log on, tune in, find out. Another good idea from Cambridge.
Business valuation is not an exact science, okay? And this is quite important because it's about who's asking the question. So, like beauty, it's in the eyes of the beholder. So an investor will have a very different perspective of the valuation of your business from your own perspective, usually at diametrically opposed ends. But that perspective may change depending on what you're actually trying to do with the business at that point in time. If you're trying to invest your own money in it, you want the valuation to be lower so that you get more of the company. If you're bringing money from the outside, you want the valuation to be higher so that you give less of the company away. Now, that's very important. So there's no exact science, and anybody who claims to have wonderful metrics, etc., forget it. This is all about working it along. So there are lots and lots of people who spend all their time just doing valuation. If you go to the big four management consultancies, the accountancy practices, they have these people who specialize in valuation, and they usually charge you a lot of money. You turn up and they'll say, oh, it's at least £30,000 to get a genuine valuation of your business. And the answer they will give you is what you actually tell them over coffee, and they'll justify it with lots of sophisticated packaging. So the entire industry devoted to this, but if you're trying to build a business, think about it from your own perspective. So valuation is actually the sum of many components, okay? So there are many things that go into building the valuation of a business. And when I'm looking at a business, typically I'd actually run through this list and try and build a little grid and say, how important are each of these components to the overall valuation, so that you get some sense of where the real value in the company is coming from. Okay, so the obvious statement is the intellectual property in the company, and that doesn't just mean patents. Frequently you may not have a patent. In the software industry, it's not that common to actually have a patent, because getting patents in software is very much harder than in other spaces. So the valuation depends on a number of things. It may be the key technologies, patented or not. It may be the processes. So you may have a very unique process for say, processing some ore into a mineral. The processes themselves, or you may have a wonderful process for doing something different. If I give you an example of something that you'll find quite amusing. When I came back to Cambridge in the 80s, I worked for a consulting company called PA. And there was a team in there that had a problem given to them, which was that, all about prawns and prawn shells. And when prawns are shelled, the shell itself is typically discarded, thrown away. And there was a scientist there, colloidal chemist, who had this idea of crushing the shells and turning it into something that could be a packaging material. And the actual chemistry was very simple. You could do it in a test tube. But the real challenge was in building a process that you could do this thing and scale it up. And that company was sold for a fortune because he was able to demonstrate the process. And the way he demonstrated the process was he actually built a pilot plant in the basement made out of glass tube, because everything else would be corroded by the chemicals they were using. And they had this massive plant in the basement with glass tubes processing prawn shells. And those of you know, prawn shells are quite smelly. And in 1989, about 2 days before the plant was going to be dismantled, they had a break in one of the glass tubes, and the whole basement was flooded with these awful noxious smells. And today, if you go back to that basement in PA, you can still smell some of the prawn shells. That's how smelly it was. Okay, but process, very, very important. And brands. Now, I don't know, how many of you are working with businesses where you think your brand's really important? Okay. Now, you probably know the story about Coke when they changed to New Coke and the disaster they had with the rebranding exercise. If you haven't, try and Google it, read it up. It's a very insightful story about a product where they tried to change the brand positioning and got it wrong, and it cost them something like $500 million. Brands, very, very important. Building a brand is terribly important. Think about Starbucks. Think about all the other brands that you see around you. You know, when Unilever bought Ben & Jerry's, did they buy it because of the wonderful recipes for the ice cream? No, they bought it because Ben & Jerry's as a brand was very valuable to them in terms of the statements that they made about eco-friendliness, the green revolution and everything else about. And so Ben & Jerry was a brand they sold. And when Ben & Jerry sold the business, they say to this day that it was the biggest regret they didn't realize the value of their brand when they sold it. Okay? In fact, they sold their names, which is even worse. Now, the other thing about evaluation is what's the underlying business model, and how resilient is it? So you build a product and you sell it. That's great, but how much is your business going to be worth if you don't have the underlying ability to carry on that business and have a resilience to support it? So take the software industry, for example. How many of you heard of something called software as a service? Quite a few people. Okay, so the old model for software was that basically you sold people licenses. So typically Oracle, you buy the product, you buy a license, you install it on your machine, and the license says you can only have 1 user or 3 users on the piece of code. And then they charge you a maintenance fee on top, and then they charge you training. And in fact, 30% of Oracle's revenues and something like 50% of their margin has come from all these maintenance services. Okay, quite interesting fact. So, not saying they're giving the licenses away, but that's where the bulk of their profitabilities come from. And so when companies like Salesforce.com started, they said, we've got an interesting sales tool that can be used to manage sales forces, but we won't sell it as a license. We'll actually offer it as a service over the web, and people will pay an annual subscription. And they bundled in the cost of the maintenance and bundled in the cost of the support. And so they changed the business model. And in the early days, people said this won't wash because the revenue model just doesn't allow for all these extra revenues to be earned from the license model. And what they were able to persuade people was this model is actually much more resilient, because once people have signed up to a subscription and they're using your services and they're hosted in the cloud, it's very hard for them to go somewhere else. The cost of switching for them become very high. Their cost of entry might be lower. So the underlying business model, if you look at any investor, what they'll be looking at when you show them your numbers, they'll say, so how can you make this stick? How resilient is it? And what happens when competitors enter into the market in terms of driving revenues down, margins down? How resilient are you? And I would argue that's probably the biggest thing in my mind that determines valuation. And then you have the usual commercial metrics. These are the usual things people want to know. How big is the market? So, people would say if this market is $100 billion, you're going to have, say, 3% market share. You could have 3%, you could have 3 billion revenues in theory. So that tells us something about your potential to grow. And therefore, we can look at the growth rate you may achieve, and that'll tell us something about your ultimate valuation. And so people will use that. Market structure is very important. What do I mean by market structure? It means the number of other people who are in that market and how they're supplying that market. So if I pick an example from everyday life, take the coffee shops. What's the difference between Cafe Nero and the shop, well, look, Luigi's down Mill Road, or the corner cafe here, the Transport Cafe down the corner? So what's the real difference? Because the market structure is quite complicated. There are different people supplying different parts of the market. And the value of what you've got will depend on your position in that structure. How much room is there for you to grow? How much can you scale? Can you hit other markets? So, for example, if you take the example of Bebo, any users of Bebo here? Probably you must have used Bebo in the past as a Facebook type. So nobody likes to say they use Bebo now because it's perceived as a 13 to 17-year-old girls thing. But Bebo had a huge valuation, and it was bought by AOL for something like $800 million, right? With lots of advice from management accountants, corporate financiers, and everything else. And when they signed the deal, one of my colleagues said, $800 million, they must be mad. They're targeting a group of people who are fickle, 13 to 17-year-olds. There's no revenue model. This group are not the typical group that advertisers will pay to reach. And the week they did the deal, there was data from Pew Research, as a consumer research organization in the US, actually talking about how revenue, the advertising yields from these kinds of businesses were dropping. Okay, so we have a situation here where the market structure should have been clear to the people who bought, and they should never have paid that kind of money, and yet they paid it. And so what's the effect now? They've had to write it down, and the business is probably not even worth 150 million today. It'll get submerged, sold off, they'll change a few CEOs, and the shareholders will lose a lot of value. And in the process, incidentally, they will destroy a lot of real value that had been created, a lot of jobs. Okay, so you get a little bit of a view from me about the cynic who says don't trust all these massive valuations. Largely, it's bullshit. Market share is obviously the classic one. How much of the market do you own? And then the usual financial metrics, all the things accountants like poring over. You know, what's the kind of revenue per customer? What's your EBITDA? How many of you know what EBITDA means here? Oh, there are a few people. That's good. It's earnings before interest, tax, depreciation, and amortization. Accountants love it because it means it's not just profit, but they can take all the other things off to try and make the numbers look good. Okay? Again, being slightly cynical. The other thing about evaluation is, you know, how mature is the business? Where are you in your growth curve? Because investors like to come in at a point where they can see huge growth. A mature business has less interest for an investor because there's less growth in it. So the valuation depends very strongly on the maturity of a business, and that's related to this perception of future prospects. Most investors coming in, angels, VCs, they're not really, today they're saying, what's our perception of future prospects? Because if there isn't significant growth, then they can't share in the upside. That's a very important lesson. Good mature businesses don't go to VCs, don't go to angels, try and get money from your bank, because they're very happy with that kind of, well, they used to be very happy with that kind of safe return of between 2 and 5% before they went betting in the casino. And now, of course, they're in trouble, so it's a bit harder. But the perception of future prospects is very, very important. How many of you know anything about diffusion? Yeah? We know the diffusion equation. The equation for diffusion basically says that things, think about how gases spread outwards. That's the equation that governs it. And that's classically the bell curve. So if I point up there, basically the bell curve, the whole curve would look like that. So it's like a top hat function. It starts and goes and comes down. What I've got up here is the left-hand side of the curve, because we're all interested in growing businesses. We're not interested in the bit of managing their decline on the right-hand side. So that's why we look at the left-hand side. Okay? And this is really about how valuation depends on the maturity of a business. So what I've got in here is I've got this curve, and I've got 3 chasms. And a chasm is basically what you would imagine it to be. It's a gulf or a gap that you have to jump over. And what this means is that businesses, as they're growing, typically they can grow steadily, but they hit these gaps where things get tough, they get rough, and you have to know how to cross those chasms, right? And there are 3 chasms. Now, what I've called the classical Moore chasm, chasm 3, is there's a book called Crossing the Chasm written by Geoffrey Moore. Anybody here read it? Geoffrey Moore's book, and he talks about the classic challenges of high-tech marketing. But that's actually the 3rd chasm, and it relates to a particular set of circumstances. There are 2 other chasms. So if I just spend a little bit of time walking through this, and this may relate to some or all of you. So if you look in there, you start off, if I can get this to work, but I can't, so I won't. If you look at the left-hand side, the idea development. So this is the bit where you have an idea, and you're generating ideas or filtering them, and then you think, this is a great idea. If only I could actually demonstrate it working. So you talk to people and they say, yeah, I'd love to invest, or I'd love to follow this through, but show it to me working. Show me how it works. I'm not expecting a full production version, but just show me even a prototype. And that's the first chasm. So that's the first developmental chasm, because at the end of it, you have a proof of concept, you have a demonstrator, and you start to have an outlined business plan. And that first hurdle, most of you are very familiar with if you come out of R&D or tech backgrounds, and that's something you kind of instinctively say, yeah, I've got to show it to somebody, I've got to demonstrate it. There are people who occasionally will give you money just on the basis of an idea without even seeing a demonstrator. I've done that twice in my life, and once I regretted it deeply, and the other time we got lucky. So it's an important phase in terms of being able to demonstrate what the idea is about. And when you have that, then the people who are actually going to play with that early demonstrator are the early adopters. They're the people who don't mind that it doesn't work properly because they're so enthusiastic. You know, the first in-car satellite navigation product, you read about TomTom and all these companies today, massive valuations. First product was actually developed by some people I knew who showed it to me working in a car. And basically, the people who used it in the car had to spend an hour every morning playing with the wires, connecting things, resynchronizing until it would work. But they were early adopters. They didn't mind that because they were so excited they could see where they were going in their vehicles. They didn't care about its reliability or anything else like that. So those are the early adopters. And then, when you get beyond that point, you've really got to build some kind of beachhead. So you've actually got to say, this is great, but now I need 5, 10 customers who are using the real thing. Okay? And that's very important because at that point you've now ironed out all the issues around reliability, reproducibility of the performance, and getting those first 8 to 10 customers is very important because these customers will be the people who will send the message out to your broader customer base. So the brand positioning of those customers is very important. So if you have, picking up an example, somebody here is working on something to do with aerosols, right? Now, if you manage to persuade your first customer to be Procter & Gamble, for example, or some brand name that's or Reckitt & Coleman, who's associated with that space, then they're your early customers, and they do a lot in order to be able to get you to the mass customer base. So that's very important, and that hurdle can be quite hard because you have to do a lot of stuff to the product to persuade reasonable brand names, reasonable customers to be able to use your product and use it and to be able to talk about using it. So they're your reference customers, right? And then the next bit is about being able to scale from that to go mass, which is what the Geoffrey Moore chasm is all about. It's saying, I got 10 customers and I spent 16 hours winning each customer. Now I want thousands of customers. How am I going to scale up? How am I going to cross this chasm? What are the marketing issues? What are the communication issues? What are the brand development issues? Now, you might think, why am I laboring the point about this cycle in a session on valuation? But the valuation curve and your valuation depends on where you are in that curve. And that's the first thing when I talk to business, I look and say, roughly, where are these guys? Because that tells me something about the risks they face, because that's one set of things that look like the anchor pulling them down. The other is how much growth is there in the business. If they're right up at the top and they're mainstream, right up at the top part of the curve, then I'm not going to get much more valuation growth except by driving numbers, by revenues, just by growing customers. So the high growth part of a business is gone by that point in time. So investors coming in that point are very, very different. So the kind of financing and the kind of valuation parameters change depending on where you're in the curve. Okay, and so there's one thing you take away is when you're looking at your own business, decide where you are and think about how you package your story to investors in terms of what your valuation you want to put on it. If you're the best place to be usually is about there because you've gone through the first 2 chasms, and you go to investors and say, look, massive growth potential, we can really grow the business. So we're worth a lot of money, factor in the future, etc. And then investors get very excited. And venture capitalists particularly are very interested at that point in time because they start saying, oh, can we do 100 times our money? And stuff like that. Okay? I started life as a mathematician, and I like equations still. And I think I asked how many of you knew about net present value before. Did I ask you that? How many of you know what net present value is, NPVs? Done some calculations? Okay. So it's, okay, so you've done good finance courses, you know that. And in mature businesses, well-established businesses that have been going a long time, the accountants like to kind of do the NPV calculation, and even when new projects appear, they'll say, oh, so what's the NPV, of this particular project, and they'll have hurdle rates and make decisions. But there's this guy called Jay Abrams who basically says that, if you have businesses that are growing and that are early stage, etc., you need a much more rigorous formula for being able to calculate valuation. And I thought it'd be interesting to share if I just tell you what these different things are. FMV is fair market value. So that's the market value of your business, fair market value. And then if you look along the bottom, you see INC is income, G is the growth rate, there's capital expenditure. So it's telling you something is the way people value a business is how much capital you're spending, what your depreciation is relative to that. because if you're in a high inventory business, you might be spending a lot of money. Depends how quickly you appreciate the equipment. And in the software, in the IT industry, now PCs are being depreciated over 2 years, sometimes in the year of purchase. Very interesting. So that's important, and then the increase in net working capital, because that measures what you need in terms of cash to keep the business ticking along. And the increase in net working capital, and R, of course, is the standard discount rate, which is the rate, if you like, that's what money costs you, basically, the cost of money. And I think this equation is great, and we've had a lot of fun trying to plot all the businesses we've been involved in over the last 15 years. And the only conclusion we could reach is this equation doesn't work. Okay?